Man, I think we all can agree that the month of January has been an awful one when it comes to the stock market. It felt like no matter what stock we were getting ourselves into, it just continued to go down. And we had people like me, Kevin, decide, you know what, I'm just going to get out of the market and make some trades here and there. But in this video, I'm going to be sharing the stocks that I'm going to be buying here in the month of February because I think that it is still a time to buy regardless of what anyone says. I mean, when we think of the stock market, a lot of people use the phrase priced in. And when things are priced in, we're referencing the future. And so even though people think that it's going to be March before stocks start going up, I would not be surprised that the month of February is actually going to have some gains considering the fact that people are going to start pricing in the interest rate hike. So before I go ahead and dive into these stocks, I need to give a warning in terms of what kinds of stocks I'm choosing. As some of you know, I posted a video of my investing strategies going into 2022. And in that video, I predicted that the best performing stocks this year are going to be ones who are either going to be profitable or are already profitable. So 3 of these stocks are actually going to be toward that idea. And the other 2 are significantly undervalued in my opinion. But the first stock that I'm going to be looking at to buy in the month of February is Palantir. This stock not only has downtraded with a lot of other stocks, but bad press and the retail investors selling have been huge factors for the significant drops we've seen in the share price. Palantir forms contracts with companies where they will receive data and then using algorithms, they help them determine what are the best things to do for their business. Now, of course, that is a very brief description of what this company actually does. So I suggest looking at the investor's presentation first and then dive into the 10K after that. But over the past year, this company's valuation has been cut in half with a market cap right now of somewhere around $30 billion. And with only $2 billion projected for the year of 2022, many investors will choose to pass on this company. But I see great potential for this company to make solid gains over the next 5 years. I love their sticky business model because it will be difficult for them to stop using the product and they'll be able to charge more for their product, leading to higher margins. The overall confidence of this company makes me even more bullish. I mean, if we're honest, especially over these past couple of years, we saw pre-revenue companies say,
oh yeah, we're gonna grow to $10 billion in the next couple of years.
But for a company like this where they have outstanding projections with revenues of 30% or more over the next 4 years, they are continuing to prove that they can meet and beat these expectations. They are also projected to be profitable this year. And with no debt, this makes this company an interesting buy, especially for hedge funds that don't want to have a lot of risk with interest rates going up this year. Based off of what this company has already done over the past year, I can see this company averaging somewhere between 32 and 35% revenue growth over the next 5 years. And by 2026, I predict that the company will have 20% of their revenues hitting the bottom line. One thing to keep in mind is that software companies will achieve better margins than hardware companies do. And with Palantir already having a solid business model, they will have tremendous opportunity to grow their margins. And I think looking at this in the short term, this company will seem overvalued. But when we look at the long-term projections for Palantir and the fact that over this past year, they've shown that they can meet expectations, I can see this company giving me some great gains in the next 5 to 10 years. And speaking of long-term potential, the total addressable market or the TAM for this company is incredible. Analysts predict that by 2025, which is 4 years from now, the TAM for this company will be $230 billion. If we gave them a conservative number and let's say that they only achieved $4 billion by 2025, this company would have less than 2% of the market share. And because of the fact that there aren't a lot of competitors right now, and they are relentless when it comes to hiring and retaining the best professionals for this field, I believe that by 2030, they could easily be somewhere around 10 to 20% of the market share. If you're looking for a quick 1-year hold or less, then I honestly think this is not the stock for you. Now, here are some factors to consider. First, the company has had bad publicity, and you've seen people like Ross Gerber talk about this company in an extremely negative light. And I believe that we can still see this over the next few months. But where I think this company is going to thrive is not in the government contracts, but more so in the commercial contracts. I think that the more the company shifts over to these commercial deals, the bad publicity will reduce and therefore lead to more investors feeling okay to open a position in this company. So when it comes to me with Palantir, I have not built my full position yet. And so I'm going to be looking to buy this company if it is under $15. And if we see the stock get back into the 11s or even the 10s, I will be buying extremely heavy. As I said before, I do believe that the downtrends could continue for this company over the next couple of months. And so if that does happen, I'm more than happy to add shares to my position. But I do believe that this company has the potential to 10x over the next 10 years if they continue to show revenues over 25% by 2025 and they show growing margins over the next 5 years. But the second stock I'm going to be buying in the month of February is Shift Technologies. Now, I'm not going to spend a lot of time on this one because I just posted an in-depth video on this company a few days ago. So if you want to know more information on this company after I've shared my points, then you can go ahead and watch that video for the full breakdown. But in this video, I'm going to share a couple of things that I didn't dive deep into in the previous video. One thing that I did say is that their price to sales ratio is somewhere around 0.25. And that is crazy to think about when you see that Carvana's price to sales ratio is somewhere around a 2. With that kind of price to sales ratio, Shift right now should be valued somewhere around $16 a share. Now granted, Carvana is a lot more established than Shift is, but Shift also has better growth than Carvana does. This company continues to prove that despite the used car and chip shortage, this company not only has been beating expectations, but they have raised revenue guidance by almost 40%. And their customer acquisition costs have been cut in half. They have also improved gross profits by over 50% in the past year. Plus, they have more cash and cash equivalents than the entire market cap. There's simply no reason, in my opinion, for this company to be valued at the price that it is right now, especially when you consider the rapid revenue growth and the gross profits that they have, which are at a better position than where Carvana was when they had similar revenues. Also, with all the online used car platforms, Shift has the best customer reviews by far. I think that because of their customer service, they will continue to gain market share, even despite GM saying that they're going to join the used car online platform. The other thing to consider is that the used car sector has a huge total addressable market. In 2019, they had a market of $1.3 trillion. So there is tremendous potential for this company. And I firmly believe that there is plenty of space for multiple companies to thrive in this sector. Now, in terms of what I believe this company should be worth right now, I think this company should at least have a value of $10 per share because of the growth that they have and their execution to improve gross profits and cut customer acquisition costs. So with all that said, I'm continuing to buy Shift. And until I see something negative with this company, I will continue to be buying at these prices and hold them for 3 to 5 years. All right, stock number 3 and 4, I'm actually going to put together for the month of February. And they are the Bitcoin miners CleanSpark and Sphere 3D. Now, I wanted to put these up together because I believe, especially going into quarter 2, Bitcoin stocks are going to do really well. So I do have some recent videos on both of these companies giving my bullish thesis, so I won't spend as much time on these. The major thing that I want to point out with these two companies is that Bitcoin has not done well over these past few months. And so if you are bullish for Bitcoin in this next year, then I think Bitcoin mining companies like CleanSpark and Sphere 3D are going to do really well. Personally, here's my prediction. I can see Bitcoin having a really nice rally, especially in the second half. But I do not think that Bitcoin will hit 100K this year. I can see a $75,000 Bitcoin, but I think it's going to be until 2023 before we get the Bitcoin ETF. And that catalyst will push Bitcoin over 100K. I really hope I'm wrong, but I would rather have a much more conservative number. But regardless, here are some numbers for CleanSpark that I find to be interesting. Right now, CleanSpark is mining 10 Bitcoin a day. And they're projecting to get 3 exahash by June or July, which would be about 50% increase. So to use a conservative number, let's assume that with Bitcoin mining difficulties increasing, they will be mining 12 Bitcoin a day for the entire year. With a $75,000 Bitcoin, that would mean that the company would have $328 million in revenue. That is incredible considering the fact that the company has a market cap of about $250 million. Now, this is also not including their energy revenue, which I believe could improve drastically over the next couple of years. Now, the risk for this company is that they stop their microgrid side of their business altogether, but I honestly doubt that would happen. I believe that CleanSpark will focus more on building up their energy side of their business. And if we look at quarter 4 earnings, which would be quarter 3 for a lot of other companies, they showed that they can continue to grow their energy revenues because they produce the largest energy revenue for a quarter in their entire company's history. Now, one complaint with this company that I've mentioned before is that they need to clean up their communication with their investors, especially their earnings calls. But I do think that the new CFO will help with that. The one other thing that I want to see with CleanSpark when it comes to their growth is that they have to keep up with their Bitcoin mining competitors. As difficulty continues to increase, their Bitcoin per exahash will decrease. And we can see that there are some competitors that are doubling and tripling their hash rates. I do not believe CleanSpark is going to be the top player for Bitcoin mining, not even the top 3. But they have to keep up in order to maintain the amount of Bitcoin that they're mining right now. As long as they do that and they continue to prove on the energy side of their business, I think that this is a great stock to be in. Now, real quick, I want to talk about Sphere 3D, who's going to be merging with Griffin Digital Mining. I do believe that Griffin Digital Mining is going to be one of the largest crypto mining companies in the world. And as long as this merger goes through, I see this company doing incredible amounts of growth over these next few years. Now, if you notice, I said one of the largest cryptocurrency miners, and here's why. Sphere 3D's development of Snapmine, which is a GPU-based cryptocurrency mining solution, provides the combined company the ability to mine other coins such as Ethereum. And this allows them to build their own miners to either use them themselves or sell them to other companies for another revenue stream. This company has some of the best blockchain connections in the world, especially because of how diverse the management team is. And this makes them an extremely attractive company. Their CEO, Rob Chang, was the CFO at Riot Blockchain, and the executive chair of the board, Brittany Kaiser, is a member of the Congressional Standing Committee on Blockchain. Now, for transparency, it is difficult to determine what the market cap is going to be after the merger goes through. If I had to take a guess, I would think that it would be somewhere around $700 million. But with the amount of miners that they're projected to have by the end of 2022 and a $75,000 Bitcoin, the company would have revenues of almost $900 million, which could be greater than the market cap. Now, there are two major reasons why I'm not adding a lot to my position right now. One is the risk of the merger not going through, but the second is not knowing what the market cap is going to be. Regardless, I see this company as a high risk, high reward play. And if all this works out, then this company could get me significant gains over the next 5 years. But the biggest reason I think that Bitcoin miners are a good buy right now is because of their gross margins despite Bitcoin falling. Now, even though the margins are reduced, both of these companies could be profitable if they wanted to. But I think they want to grow their business more, which I personally believe is a smart move. So as long as you are bullish on Bitcoin, then these companies could be safer buys. And the last stock that I'm going to be buying in the month of February is BurgerFi. So this is a stock that I haven't really talked much about on this channel, but I see tremendous potential for this company because of the moves they've made over the past few months. I have to say, I'm more excited now than when I was first investing in this company. And I think this company has the potential to 2x over the next year as long as they continue to execute on expanding their business. Now, this stock has gotten hit massively, not only because it's a small cap, but because it used to be a SPAC, and they've been public for about a year now. So a couple of weeks ago, BurgerFi released their expected Q4 numbers and their 2022 guidance. In terms of numbers, I'm pleased with it, but the lack of execution of opening stores was not what some people wanted to see. The company had 2021 revenues of $68 million. Now, the breakdown of these numbers is what I think is most important. The 12-month BurgerFi brand revenue was $46 million, and the newly acquired Anthony's brand was $22 million from the period of acquisition on November 3rd, 2021 through the end of the physical year. That means that just Anthony's coal-fired pizza alone generated over $22 million in revenue for the entire quarter. That's incredible. I personally didn't expect the revenues to be that high. Now, the piece of negative news that I wanted to share was that they didn't open as many BurgerFi stores as they wanted to. They expected to open 18 restaurants by the end of the year, and they were only able to get to 16 restaurants because of Omicron. But one thing that's really important that the company has talked about in their previous earnings call is that it's not like these restaurants are not opening at all. They're simply being pushed back. So we could see some strong increases in store numbers for this upcoming year. But looking at their 2022 revenue guidance, I'm extremely excited for these numbers. The company right now is expected to have somewhere around $180 and $190 million in revenue, which is over 150% increase from last year. That is incredible for a food company that has a market cap right now of $100 million. But here's what we have to recognize. The growth for the combined company is only going to be a mid-single digit increase, but they are also planning on opening 15 to 20 new restaurants. So the growth for this company is still there. The last piece that I want to share for this company is their guidance for their EBITDA. Their total adjusted EBITDA for 2022 is expected to be somewhere around $12 to $14 million. This is great to see because it appears that the company is focusing more on profitability. And it's been reported that Anthony's Cold-Fired Pizza already has strong profitability. And on top of all of this, there's been some recent insider buying, which also shows the management team's confidence in this company. And that's really exciting to see. Now, there is a red flag with BurgerFi because they have debt of over $71 million. But I believe that this company is going to make up for those losses quickly. With this acquisition, BurgerFi will now have 177 stores worldwide, but I still see this company continuing to grow over the next 5 years. Their new CEO, Ian Baines, was the CEO of Anthony's Coal-Fired Pizza and the former president of Cheddar's Scratch Kitchen, who is now a part of Darden's. And one thing to know about Baines is that he was the CEO of Cheddar's when they got acquired by Darden's for $700 million. And the private equity firm that owned Cheddar's before the acquisition is a major player in this acquisition and is now one of the largest shareholders in BurgerFi. Now, the former CEO of BurgerFi, Julio Ramirez, has stepped down from his role, but I believe that Ian Baines has better executive role experience. And so I trust that this current management team is going to do really well in the next 3 to 5 years. This company could have a valuation of $1 billion as long as they pay off debt and continue to grow not only in the US, but also internationally. BurgerFi has just established new restaurants in Saudi Arabia, but with a $1 billion valuation, that is 10x from the current market cap. So when we compare BurgerFi to their competitor Shake Shack, we can see that not only do they have more products, but Shake Shack shows some upside for BurgerFi. If we were to compare the price to sales ratio between the two, Shake Shack has a 2.62 price to sales ratio, whereas BurgerFi has a price to sales ratio of 0.6. If BurgerFi were to have the same price to sales ratio as Shake Shack, then this company should have a share price of $23. But I think there's a major reason as to why this company isn't valued higher. Shake Shack, unlike BurgerFi, has had net income over the past couple of quarters. I do believe that BurgerFi will be profitable over the next couple of years, but Shake Shack does have that advantage. But with all that said, I do see BurgerFi as a buy right now, and I will be adding to my current position. The one thing that I will be paying attention to, however, is the growth the company is going to have over the next year considering their low expectations. I believe that as long as they work towards profitability and reduce the amount of debt that they have, then this will get me some solid gains, especially over the next 3 to 5 years. But I hope you guys enjoyed this video. If you don't mind, would you consider destroying that like button? That helps this channel immensely, as well as comment down below your thoughts on the top 5 stocks that I'm going to be buying this month. Would love to hear your thoughts on that. And if you are new here, hit that subscribe button down below. That way you are notified when new content comes out. Hope you guys enjoy the rest of your week, and we'll see you in the next one.